Good morning, Carl. Yeah, the CNBC Fed Survey shows respondents expecting the Fed to hike this week by a quarter. That'll bring the funds rate above 5% for the first time since 2007. And then they expect it to stay there for a long time, up to 8 months. However, 59% saying the Fed should not be hiking rates because of potential fallout from troubles in the banking sector. The survey's gauge of systemic risk in the financial system down from March, but remains pretty high. You can see there it was 41% saying that systemic risk was somewhat or very high, 44% back in January. That bumped up to 72% when we took our survey in the wake of the failure of Silicon Valley Bank. Now it's down, but just a little bit. 63% still saying that systemic risk in the system is high or somewhat high. And I'll take a look. There's some, but not much worry about the U.S. Probability of default here, up to 11% from 6%. But still, Wall Street's not really focused on that as a major source of risk, at least not at this time. Concerns about the banks is just one of the factors leading to negative views of stocks among our 27 respondents. Relative to your earning and economic growth forecast, stock prices now are 65% say extremely or somewhat high. They think this market is overvalued. Just 23% saying about right, and not many out there thinking that there are bargains to be had. We do this risk-reward ratio. We ask what's the chance of a 10% increase or decrease in stocks in the next 6 months? Minus 16. So how do we get there? Well, 47% say there's a chance of a 10% hike. 33% saying there's a higher chance 10% decline. Now, the outlook for the S&P down more than 2% through year end, but up 7% next year. So this group sees difficult times ahead through the end of the year, but a bit of a bounce back next year being built into the equity forecast, guys.